Well, I want to cover something that I think people have to realize. You, even though it's still early in your fiscal year, you felt confident enough to raise your full-year outlook. So anyone who thinks that the stock should have gone down at the beginning, I don't know how to jive that. You gave a pretty good outlook here.
Well, Jim, I'm going to have to read your book to understand the markets. I can't figure it out.
Me too.
Yeah. So what I'm telling you, look, we're off to a strong start in our fiscal year. This year, we delivered 17% revenue growth. Not too shabby. We beat earnings per share by 2 cents. We had adjusted operating income growth of 15%. And quite frankly, you mentioned margins. Our adjusted margins, 41%, still industry leading. And really, that performance is reflective of really continued progress on our Paycor integration, the acquisition we completed earlier this year, continued sustained demand for our human capital management, our HR outsourcing solutions. And then, quite frankly, Jim, it's really in a backdrop of what we're seeing is a very resilient and stable small business employment market. And so those three things together gave us confidence. We actually raised our earnings per share guidance to 9 to 11% for the full year. And we reaffirmed our revenue guidance between 16.5 and 18.5%. I think those are solid numbers. And remember, we're early in our year. Our big selling season gets started here in the second quarter and third quarter. So we felt good at this point in time based upon the success we're having at Paycor, based upon what we're seeing in driving operating efficiencies as part of the acquisition and continuing to leverage technology to drive margins, we felt confident we could raise earnings per share for the year.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.